Good day, ladies and gentlemen. Welcome to my channel. Today is January 21st, 2023, and I'm going to discuss gold only. Last week, I suggested that gold is approaching a multiple resistance zone standing from 2020, and that some caution is required. Over the passing week, gold formed rather a shallow 1.7% correction, but managed to fully regain and even close 0.3% higher. Despite this, senior gold miners GDX lost 0.7% on a week, so not that much happened over the passing week. Gold still has some steam left, and the target that I have set for myself in the present cycle is $1,975 mark. Although that doesn't mean that gold couldn't test $2,000 or even all-time high. Gold could momentarily spike above multiple resistance zones, but eventually it should pause and correct back under the key resistance in order to consolidate gains and then start another sustainable cycle up to new highs. I wouldn't want gold to test all-time high in the present cycle, as that would be quite unsustainable and overstretched price action not supported by gold miners, which could lead eventually to a deeper correction. I would like to zoom out and study the case from 2009, which in my opinion is quite similar to the present case. Note how gold broke the major rising trend line, however, managed to fully recover, break down, and produce a strong rally. Let's zoom in. Gold, coming out of a false breakdown, tested a major rising trend line, but didn't manage to eclipse all-time high, although got quite close. Then a multi-month correction and consolidation took place before gold managed to legitimately break out. I believe gold is setting up for something similar in the present rally. Let's go back to the present time. As you can see, gold came out of the false breakdown rather in a straight line. My guess is that gold still has some room to advance, since it hasn't reached the key resistance levels. The ideal scenario would be that gold does make a pause over the next 1-2 weeks, and during this consolidation forms a slightly deeper correction towards $1,875, $1,885 level, but quickly recovers. Once all the February gold future contracts, which stand in a quite significant volume, expire by January end, and will leave upcoming FOMC meeting on February 1st behind us, I would want gold to push one more leg up in the present cycle towards $1,975 or higher. Sideways price action over the coming 1 or 2 weeks could potentially allow gold miners to catch up and make the eventual longer-term correction less painful. In order to get the most out of the present rally and allow gold miners to catch up, the best would be if gold slows down the pace of its advance and consolidates recent gains over the coming 1-2 weeks. However, it doesn't mean that gold cannot push further in a straight line towards 1975 or even higher. I welcome any surprise upside price action in gold, but gold miners should not be left behind in such a significant way, as it is almost always a bad sign. This is it for today. Stay well and enjoy the weekend. Please note that this video is not an investment advice and prepared solely for educational purposes.